Yeah, so today is our day 5 of the webinar series where, as we discussed, we are going to be discussing about all the intricacies around taxability of an irrevocable trust. Okay, so since today we are starting with the discussion on the Income Tax Act, what I thought is I'll also give a very ready referencer for you guys, which covers the entire gamut of sections under the Income Tax Act that you guys need to refer to whenever you're dealing with any kind of cases in relation to a private family trust. So, and to make it more easier for you, I have divided this section summary qua each life stages of the trust. Okay, so first section is about the basics, where section 231 is very important. Sorry, and one more instruction is, so today in the entire presentation I have given references to IT Act 2025 as well, as that is going to be more important for you guys. But in the course of our discussion I will be referring to the sections of IT Act 1961. Wherever there are variances I'll be happy to address them, but otherwise generally I'll try and give reference to IT Act 1961 so that it's much more easier for you to resonate with. Okay, so person is defined under section 231. So as we had discussed earlier, the trust is not a person, so the definition of person becomes very important. Then section 5 and section 6 talk about residential status and scope of total income being important for a trust as well. Then the first stage which we have discussed in the life cycle of the trust is that of the stage of settlement, right? So at the stage of settlement, whatever things arise, I have summarized that over here. Let us see one by one each point. So we had discussed when we were discussing the Indian Trust Act that at the stage of settlement there is actually a transfer of asset happening from the settler to the trustee. Okay, so we are saying that there is a transfer of asset. Now we all know that any transfer of asset leads to capital gains. So transfer is quite important, and we need to understand the definition of transfer, which is given in 2 subsection 47. Once we conclude that there is a transfer, then we have to see the charging section of capital gains to understand whether this particular transfer is going to be a capital gain triggering event or no. Okay. Then there is a section 47 which lists down lot of transactions which are transfers, but the Income Tax Act has purposefully not decided to tax those particular transfers. So there is a section which says that there are transactions which do not get regarded as transfer, and thereby they come outside the ambit of the capital gains. So that is why section 47 becomes important. Now all these 3 sections we are studying from the angle of the settler, who is the transferor of the case. Okay, now for every transfer there are 2 parties. One is the transferor and one is the transferee. The transferee in our case is nothing but the trustee. So we, at the stage of settlement, we also need to evaluate the tax implications in the hands of the transferee. And the transferee being the recipient, we have to see income from other sources, especially section 56 to 10, to see that when the trustee is accepting the property from the settler, is there a receipt in the hands of the trustee which leads to a tax under section 56, which is income from other sources. So this entire gamut will cover the stage of settlement for you. Once settlement is done, then there is a life cycle of the trust, a lifetime of the trust, where what we say is that now the trustee is managing the assets for the benefit of the beneficiaries. This, generally speaking, is going to be the longest period in the entire life cycle of the trust. So during the lifetime of the trust, you have to see what is the type of the trust: revocable, irrevocable, specific beneficiary, discretionary, and accordingly the taxabilities would change. So for revocable trust, irrevocable trust, specific discretionary, which sections you would have to refer to, we have given it over here for your ready reference. Now, once the lifetime of the trust reaches its maturity, that is when we reach at the stage of distribution. So now the trustees have decided to pass on the asset to the beneficiary and wind down the trust, or maybe not wind down, partial distribution is also fine. So the stage which comes in the life cycle of the trust is called as the stage of distribution, where the trustee is distributing asset to the beneficiary. So here it is not a taxable event. Why? We will understand in the case study, not going much in detail over here. So since it's not a taxable event, so there are no sections which have been highlighted. Okay. Then what happens is, at the stage of distribution, trust structure is wound up, dissolved, it dies. Now what remains is the asset is finally in the hands of the beneficiary. The beneficiary may continue to hold that asset, or he may decide to sell off the asset as well. It is his choice. So the last leg in the entire life cycle is going to be the ultimate sale by the beneficiary. Now sale is also a transfer. So if there is going to be an ultimate sale by the beneficiary, then we will have to compute capital gains in the hands of the beneficiary. So at that point of time, one important aspect which will come into place, what is to be the cost of this particular asset, because this asset has been in the conduit pipe of trust for a very long period of time. So what will be the final cost in the hands of the beneficiary is an important question, where section 49 comes into play. Yeah. And finally, I've given some residual sections which are more sort of in anti-avoidance kind of in nature. So just in case if say someone tries to use the trust structure for maybe say a tax evasion purposes or tax planning purposes, then section 93 would come into play. And those sections can be referred to, but we are not going to be covering this as part of this webinar series, because it's altogether a very different discussion. But for your reference, I've mentioned it over here. Yeah. So this was the entire gamut of the sections for the entire private family trust taxability related part. Okay. Now we will directly jump into a case study. Okay. So what I thought is, rather than theoretically explaining all the provisions, a case study and looking at the entire end-to-end life cycle of that case study, we will get complete hold of on all the taxability provisions of a private family trust. Yeah. So let us first see the facts of the case. Those are very simple. So there is a settler. Okay. The settler has purchased certain shares. Okay. At this moment, he's not even a settler, he's an individual. Okay. So an individual has purchased certain shares when on 1st April 2019, and his cost price is 1 lakh. Okay. Now this particular gentleman holds these shares for 4-5 years with his own, he was enjoying those shares. Okay. Now after 5 years, he reaches 2024, and a thought comes to his mind to plan for his succession. So he settles a trust, and exactly these shares are now settled in the trust on 1st April 2024. Okay. So settlement happens on 1st April 2024. Here we will have to see what kind of taxability arises. And a fact which I have mentioned over here is, on 1st April 2024, the fair market value of these shares was 1,50,000. When he purchased, it was 1 lakh, and over a period of 5 years, it grew to 1.5 lakhs. Okay. Now the trustee is holding those shares. The trustee also holds those shares for a long period of time, say a couple of years. During the time when the trustee is holding the shares would have earned certain income like dividend. So I have assumed that in one of those years, the trustee earned dividend income on those shares. Okay. Then the trustee reaches the year 2028, where now the trustee feels that it's the right time I should make distribution to the beneficiaries. So in 2028, the trustee makes distribution of the shares to the beneficiary. Here also the trustee is not, and for simplicity's sake, we are assuming that the same shares are carried out throughout. Okay. So the same shares, now the trustee is distributing to the beneficiary, and he is not liquidating and distributing money. It is distribution in kind, where the property in its whole space and spirit is moving on to the beneficiary. Assuming this happens on 1st April 2028, on this day, now the fair market value of the shares has risen to 1,75,000 rupees. Okay. After distribution, as we discussed, now the beneficiary is holding the share in his own capacity. Okay. Once the beneficiary received the shares, and when he was holding it in his own capacity, which means at this stage the trust structure has died down. it is end of story. Now it's a separate journey only for the beneficiary as an individual. When he was holding those shares in his own capacity, he also received dividend income on those shares. This dividend income, let us say, for example, it is 3,000 rupees. Okay. Now the beneficiary holds those shares for few months, and then on 30th August 2028, the beneficiary decides to ultimately sell off the shares to a third party. That means the property is now completely moving out of the family. So this is the sale event, ultimate sale event. It is happening on 30 August 2028, and let us assume that the actual sale price for which the beneficiary sold the shares is 2,10,000. Okay, it's very clear with the case. It's very simple case. It starts with the person first buying the property, then settling that in the trust, then making distribution to the beneficiary, and finally the beneficiary sharing the property to a third party. And for this first case study, we are assuming that it's a irrevocable trust. Okay, we had discussed the classification. You have to first see qua the powers of settler. So qua the powers of settler, this is an irrevocable trust. Then we had seen that after classifying qua the powers of settler, you also have to see how the powers of the trustee in relation to distribution are. So for this case study, we are assuming that it's also a discretionary trust, right? So the trust which we are going to see in this case study is irrevocable and discretionary in nature. Yeah. Now, qua each stages, I have put down all the key implications over here. So let us start from the stage of settlement, and we'll move on to the last stage of disposition by the beneficiary. Okay. So what happens at the stage of settlement? Now, as we discuss, at the stage of settlement, there is a transfer that is happening. Okay. Where is the transfer happening, or between whom is the transfer happening? The transfer is happening between from a settler to the trustee. So, tax implications we have to independently judge in the hands of both the parties. First in the hands of the transferor, and then in the hands of the transferee. So here let us first understand what is the implication in the hands of the settler, being the transferor. So it falls in the definition of transfer, that is very clear. It falls in the charging section of capital gains, section 45, that is also clear. Then we move to a section 47, subclause 3. This section says that the following transactions are not regarded as transfer. Let me I have the extract of section 47.3 here. So let us see that section. What the section says is that the following transactions are not regarded as transfer, and the bullet point 3 says any transfer of a capital asset by an individual or a HUF under a gift, will, or an irrevocable trust. So if there is a transfer of asset under an irrevocable trust, then for the purpose of transferor, that is a settler, there is no tax liability. Okay, we have to appreciate a couple of points over here. So I'll go point by point. First is there was an important amendment to this particular this particular subsection by the Finance Act number 2 of 2024. Okay, what the amendment did was, prior to the amendment, this particular section read as any transfer of a capital asset under a gift, will, or an irrevocable trust. In other words, it was not agnostic to the type of person. It was open. Any transfer of an asset happening under an irrevocable trust was not regarded as transfer, and thereby no capital gains. So earlier, if say there was a company had certain assets. If the company is settling a trust for the benefit of certain individuals, and the company is settling the asset into the trust, then the company was not liable to any kind of capital gains. This was as per this particular section because it was not agnostic to any class of person. Then there were certain tax evasive practices which were going on in the market. So to curb that, the government brought in an amendment and restricted that this benefit of this particular provision is only available if the transferor, in other words the settler, is either an individual or a HUF. Okay, so it is an individual or an HUF. Another important point over here, see here they have only mentioned transfer being under an irrevocable trust. Revocable trust is not mentioned over here. What does this interplay, that we will see in the next webinar when we will be discussing about the revocable trust. Okay. Now moving back to the slide. So we understand that as per section 47.3, this is not considered as a transfer. So for the settler, there is no transfer. So the settler does not have to evaluate any capital gain implications. Yeah, sorry, one more point over here is important. This section is agnostic to the class of the recipient as well. Okay, that is very, very important. Say for example, I am an individual. I am settling shares in a trust, and I am making an LLP as a beneficiary to the trust. Now, in the definition of beneficiary as per Indian Trust Act, we had learned that any person who is capable of holding a property can become a beneficiary. So, a limited liability partnership is a body corporate. A body corporate can hold property in its own name. So, LLP can also be a beneficiary in the trust. So, if I am settling a trust where I have made LLP as a beneficiary, and if I am making any settlement into the trust, in my hands there is still not going to be any capital gains. Why? Because section 47.3 has no condition around who the recipient has to be. Yeah, very important point. I will come back to this point in a while. Just remember it for now. So as per section 47.3, this is not considered as a transfer in the hands of the settler. So on the settler's part, there is absolutely no tax liability. Next is state change as person. We already discussed it, the amendment of 2024 Act. Now this brings us to the end of the part of the settler as far as stage of settlement is concerned. Now we change shoes and come into the shoes of the trustee, who is the recipient in this case. What happens in the hands of the trustee? The trustee has received some property from the settler. So whether there is any taxability in the hands of the recipient, we have to see. Why? Because section 56 to subsection 2, it says that if you have received any property from someone, then it is taxable under the income from other sources unless and until there is a specific exemption for it. Yeah. So let us see section 56 to 10. So there is an exception 10x to proviso to section 56 to 10, which says that this clause shall not apply, meaning this clause as in this would not be treated as income to any sum of money or any property which is received from an individual by a trust created or established solely for the benefit of the relative of the individual. Okay, now here there is many differences than for section 47.3. So to appreciate that, I have kept both the sections together over here. See, let us go step by step and highlight each of the differences. First difference was, in section 47.3, an individual was also a transferor plus an HUF could also be a transferor. Okay. However, when we come to exception 10, proviso to section 56 to 10, here the transferor can only be an individual. Here they have not covered HUF. So if an HUF is settling asset, then for 47.3, HUF will get the exemption and HUF won't have to pay any capital gains. But the trustee, being the recipient, will have to pay tax under section 56 to 10. Why? Because over here in the exception, trustee HUF as a transferor is not covered. Here only individual is covered. This is one point of difference which is very important. Next was here, as I had mentioned, there was no restriction on the recipient. Okay, there was no restriction on who the recipient has to be. But when we come to section 56 to 10, there is a restriction. What it says is, the trust has to receive asset from an individual plus it should have been established solely, means 100%, no room for any grayness. It's accurate, 100% solely for the benefit of the relative of the individual. So in 56 to 10, again there is a restriction on the eligibility of the recipient as well. So the recipient has to be a relative of the individual. Who this individual is, they are referring to the transferor. So there is a lot of difference. 47.3 is very open. On the transferor category, HUF and individual both are allowed. On the recipient category, anyone is allowed. But 56.210 at both the places has created restrictions. The asset has to come from an individual, plus it can only go to an individual or an HUF. Very, very important difference which we have to keep in mind. Yeah. Now, coming in the hands of the recipient, in our fact pattern for the timing, let us assume that the recipients are also relatives of the individual, because the context of our entire webinar is succession planning, where everything is going to be within the family. Yeah. So, this particular exception will come into play, and the recipient, who is the trustee, will also get the benefit of it, and there will be no tax in the hands of the trustee. So, at the stage of settlement, there is neither tax in the hands of the settler nor there is tax in the hands of the recipient. Now, there is a very important case law by the name Buckeye Trust, which we have to bear in mind for the stage of settlement. It's a very recent case law. First, the ruling was pronounced in 2024, December 2024, but the ruling had to be recalled by why? Because the judges had used certain AI tools, and those AI tools had hallucinated and generated certain fake Supreme Court judgments. So the entire ruling had to be ruled back. It was a very shameful situation even for the tribunal, but it was way around in news as well. I'm sure you would all have heard about it, but let's ignore that part and focus on the tax part. Now the new ruling has come out in Feb 2026. Okay. Now, as per this particular ruling, what happened is, in this particular case, in the trust deed, there was a provision which stated that the trustee has the power to add beneficiary in future. Okay. Currently in Buckeye Trust, there was a settler and only relatives were beneficiaries. But somewhere in the trust deed, there was a small power which was given to the trustee by stating that the trustee can add beneficiary in future. Now, the tribunal focused on this particular aspect, and they denied the exemption under section 56.210. Why? Because as we discussed prior, that in 56.210 the transferor is also specified and recipient is also specified. So the extract of 56.210 is here again. What it says is, the transferor has to be an individual and the trust should be created solely for the benefit of the relative of the individual. Okay, so the tribunal emphasized on this particular aspect, that as per the provision, exemption is available only if your trust is solely for the benefit of the settlers, benefit of the relatives of the settlers. Now, if you are giving a blanket power to the trustee to add any beneficiary in future, then maybe the trustee in future might add his own friends as beneficiary. He might add certain charities as beneficiaries. Those are not going to be relatives of the settler. So there is a contingency that a non-related person can get added as a beneficiary, and that is why you are breaching the benefit of section 56.210, and we will not grant you that exemption. So though in the hands of the settler there was no capital gains, but in the case of this trust, the entire settlement amount has been put to tax in the hands of the beneficiaries. Now, whether they are going to file appeal against it or no, it is yet to be seen. It's a very recent ruling of Feb 2026. We might get to see in due course. But at this moment, if you are planning any trust, you have to be very, very clear that if you are mentioning any non-related party as beneficiary, then using this particular case, your entire settlement can become taxable. So, very, very important ruling which we have to keep in mind. Yeah. Another far-reaching effect of this particular ruling is, earlier, for all the trusts, there used to be a fail-safe mechanism where what they used to say is that there used to be multiple layers of beneficiary, and at the end they used to say that if any remote situation arises where based on the above clause it turns out that there is no beneficiary in the trust, it's like a deadlock situation, then in such case, rather than the entire corpus going to government or to the court, we would want that to get donated to a charitable house with whom the settler resonates. So they used to keep such kind of a fail-safe mechanism as part of the deed. Now that is going to be very difficult. You will no longer be able to use that. So very important to plan your trust in light of the Buckeye Trust. Now moving to the hands of the trustee. The trustee has received the asset, At the stage of receipt, we have seen that there is no tax in his hands. Now the trustee has earned dividend income during the life cycle. What happens in the life cycle? In the hands of the trustee, since this is a discretionary trust, so as per section 164, entire income is going to be taxed at the maximum marginal rate. Okay, so if the dividend income of 5,000 is earned, so ideally the maximum marginal rate should be 30%, but there used to be a lot of litigation around it. What used to happen is the definition of MMR, the department used to say that maximum marginal rate is the base rate plus the highest rate of surcharge plus cess on that, and then they used to calculate the maximum marginal rate. This was wrong interpretation of the law, but still there was a lot of litigations going on around it. Now there is a very good case in the case of Aradhya Jain. It is also a very recent case of 2025. This particular Mumbai ITAT ruling has kept all these litigations to silence because it's also a special bench ruling. What this ruling stated is income tax rate is MMR as per section 164. However, surcharge would still be dependent on the quantum of income that you are earned, and by default it should not be the highest rate. So in our case, if say the trust has merely earned income of 5,000, it is much below any particular limit of surcharge, so there should be no surcharge levied on this particular income. Let us take an example. If say the income earned by discretionary trust is 1 lakh, the tax rate would be MMR, which would be say for example 30%. There would be no surcharge in this particular case. Why? Because the income is less than the surcharge threshold. So again, an important case for irrevocable for all the trust cases. So in the hands of the trustee, we have understood that the dividend income is going to be 5,000. Now, in case of discretionary trust, general principle is that the trustee pays the tax at trust level. Why? Because we do not know how much each particular beneficiary is going to earn. But there are certain trusts, which we have also seen in our case also, where income is earned by the trust in the same year, distribution is also made to the beneficiary. So qua each year's income, certain level of specificness has come into play. So there is a Supreme Court ruling in the case of Kamalini Khatau. This ruling states that if say the trustee earned the income, one option was that trustee would have paid a maximum marginal rate on that income. But if MMR is higher, then the trustee can make distribution to the beneficiaries. If the distribution is made during the year, then even though it's discretionary trust, you get the option to consider this as a specific trust to the extent of this income and pay tax in the hands of the beneficiary. So now MMR would not be required, but qua each beneficiary, whatever will be the tax liability, they will discharge on their own self. So this is also a good option available for a discretionary trust, which we have mentioned. Now moving to the stage of distribution. At the stage of distribution, as we said, it is not a taxable event. Why? Because see, trust is not a structure or a person in between. It is like a conduit pipe. The settler wanted to give something to the beneficiary. He was not sure whether he wants to give it today. So he settled that as part of a conduit pipe where things come over here. It will stay in that conduit pipe for a period of time and finally it will move to the beneficiaries. So when the settler, when is a transfer happening? It is happening when the settler has transferred the asset. So we have evaluated all the tax liabilities at the stage of settlement. During the life cycle also, on all income taxes have been paid. So now when distribution is happening, it is not a taxable event. It is merely that the right of the beneficiary has now been settled. Okay. So at the stage of distribution, when assets are moving from trustee to beneficiary, there is no capital gains in the hands of the trustee. There is no income in the hands of the beneficiary, as it is not at all a taxable event. Yeah, this is not at all litigative position. You will not find much case laws also supporting to that because this position has never been challenged. Okay. Finally, after distribution, whatever dividend income is earned by the beneficiary, it is much obvious it is going to be taxable in the hands of the beneficiary. Now, the last leg, where the beneficiary decides that I want to sell the asset to a third party. That time the sale price is 2,10,000. So the beneficiary is computing its capital gains where they write sale consideration 2,10,000. Now what is the cost that has to be deducted from that? So there is section 49(1)(3) This section clearly states that if the current owner had received the asset under a trust, then the cost of the previous owner is going to be the cost of the settler. Now in this case, who is the previous owner? Whether I have to consider the trustee, where the rate was 1,50,000 FMV, or I have to consider the settler. So it is very clear that we have to consider the settler. Why? Because the trustee is only a fiduciary capacity, is only the conduit pipe. So proper owner with right title and beneficial ownership was the settler. So his cost is going to be adopted by the beneficiary. So this completely covers the entire life cycle of irrevocable and discretionary trust. This covers major part of our PPT as well. Now this is my last slide where briefly we will cover what if this is irrevocable and a specific trust. Stage of settlement, everything remains the same. There is only change in the life cycle of the trust, where we discussed the Supreme Court decision of Kamalini Khatau that if there is distribution in the same year, the trustees do not pay tax at trustee level. The beneficiaries can pay tax as part of their own return. So same thing happens even in the specific trust. The industry practices that the beneficiaries will pay tax in their own hands. Trustees can also pay the tax. In that case, as per section 161, it says that trustees are taxed in like and same manner as that of beneficiaries. So the quantum of tax liability that would arise in the hands of each beneficiary, you total that up and then the trustee pays that. But there are certain practical difficulties in the ITR to do that. So the industry practice is that the trustee will not offer income at his level. Whatever is the specific beneficial interest, each beneficiary will take that income, add that to his other income, and as part of his return of income only he'll pay the taxes. Here there are certain practical difficulties. What happens, say for example, say this is dividend income on which the investee company has deducted TDS. Now the investee company would have deducted TDS against the PAN of the trustee. But here we are saying the income is going to be offered by the beneficiaries. So how will the beneficiary get the credit? So there is a mechanism available in the ITR where you come across, if you see the TDS schedule, there it states that if you have received certain credit in your PAN, but you are not the beneficial owner of that income, then you have the option to transfer the credit to the beneficial owner. Okay, so as part of your ITR you can do that. So what would happen is the trust would file the return first. Qua each proportion of the beneficiary, the trust will move on or transfer the credit against the PAN of each of the beneficiary. And once the trust return is filed, then the beneficiary file their own return. However, they will not be able to see this TDS credit in Form 26AS. Currently, that functionality is not live. But the beneficiary can get information from the trustee and they can claim that benefit as part of their own ITR by claiming the TDS credit. Now, there are practical difficulties over here. What happens is that generally we have seen in recent years, the ITRs of individuals get processed very fast, sometimes even in one single day. But the ITR of trust might take time to process. So we have seen situation where what happens, the trust has filed the return, but the ITR of trust is not processed. Before that, the beneficiary files the return and beneficiary's ITR gets processed. So the income tax department or CPC doesn't know that the beneficiary is eligible for this credit. So they will disallow the credit and you will be in the long trail for rectifications and everything. So a strong suggestion would be that for such a situation, always have good amount of time, file the trust return first, wait for few days, try and see if the trust return can get processed. As soon as it gets processed, then if you file the beneficiary's return, your life will be a lot more simpler. Yeah. Next is nil return is generally not accepted by the trust ITR. It raises the utility raises some query. So you'll have to give an ad hoc figure of 101 or so to do that. Another practical challenge, what happens is that, we all know that the investee companies keep on revising their ITRs. Now say the trust filed the return, passed on the credit, beneficiaries also filed the return, everything got over. After a few months or years, the investee company modified the TDS return, they revised that TDS return. So the eligible amount of TDS credit got modified. Now what to do? because trust will say that why should I file the revised return? You are the beneficial owner of that, and beneficiaries will not be able to claim the new tax credit till the time the trust files the return. So you'll have to revise all the returns if the time is available. If not available, then the trust will first have to approach the AO, get the updated TDS credit, then pass on to the beneficiaries, and then even the beneficiaries will have to approach the AO to get that. So it will be a very long cycle. So that's also a bit of an hardship around that, but we have to live with that. There is no solution for it right now. Finally, distribution and disposition by the beneficiary. Both these particular provisions remain constant even for specific trust. Here, only in life cycle there is small change between specific and discretionary. Where in discretionary there was maximum marginal rate. In specific, there is never maximum marginal rate. It is qua what is taxability in the hands of the beneficiaries. Yeah. So with this, we have completed the taxability of the irrevocable trust. So apart from this, I don't think so we have left out on anything. But still, yeah, if you guys have any queries, we can now begin the Q&A section.